Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you the day's schedule of events for Wednesday, January 20th. Well, overnight we had the fourth quarter New Zealand CPI. On a year-on-year basis, the country now has effectively no inflation, which is far below their 1% to 3% target. As far below target as, say, the ECB is. And the ECB has instituted negative interest rates, not a positive 2.5%, the highest in the G10, if I remember correctly. So, the RBNZ has a lot of room to cut rates and are likely to, in my humble opinion. That should be negative for the New Zealand dollar. Now at 9:30 GMT, the UK announces its average earnings for November and the employment data for December. The falling rate of pay settlements recently has been a puzzle for the Bank of England because pay rises are slowing even as unemployment falls further. The year-on-year rate of increase in pay settlements has slowed from 3% to 2.4%. While the three-month change annualized has collapsed to less than 1%. The year-on-year rate of growth is expected to dip further to 2.1% in today's data. That could prove negative for the pound. The unemployment rate is expected to remain steady at 5.2%. Then comes the U.S. data. At 13:30 GMT, the U.S. announces housing starts and building permits for December. Housing starts are expected to rise modestly, but the more forward-looking building permits are expected to fall back somewhat after a sharp rise in November. That could add to the slight drop in yesterday's National Association of Home Builders Housing Market Index to give a negative view on housing. Now, a slowdown in housing could call into question whether the Fed can continue to tighten rates, and so would be negative for the dollar. At the same time, the U.S. will announce the December Consumer Price Index. The CPI isn't the Fed's target, but it is, of course, the most widely recognized measure of inflation. No change from the previous month, which is the forecast, means some acceleration on a year-on-year basis, but still not enough for anyone to think that the Fed's near to meeting its target. Note that the core CPI is running above the core personal consumption expenditure index, which is the Fed's target. So even a further rise in that might be discounted as irrelevant for the Fed's preferred measure. Finally, the big focus of the day will be the Bank of Canada rate decision at 1500 GMT. Analysts and the markets are looking for a 25 basis point cut in rates. They could, in theory, stand pat, or they might stand pat. The Canadian dollar has been collapsing recently, and that's caused a big rise in the price of imported food, much to the stress of the average Canadian. Nonetheless, with inflation still well below the Bank of Canada's target, they may feel that they have room to cut rates to help the economy, which has been battered by the plunge in oil prices. Moreover, the Bank of Canada is pinning its hopes on a revival of non-commodity exports to get the economy moving again. However, this isn't taking place because much of the manufacturing industry moved elsewhere during the early 2000s, when Canadian labor costs rose and the currency was much stronger. As a result, the volume of non-commodity exports hasn't recovered to its pre-crash levels yet. This probably gives the Bank of Canada a bias for a weaker currency. The results could be negative for the Canadian dollar. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.